All right, welcome back to another episode of Asset Coach and Tax Strategist. And heck yeah, we did it. 100 subscribers. Thank you so much. I'm so excited. It's one of those things where you're doing something for fun, and you just want to share this and knowledge and information, and that's what's so beautiful about the avenue of YouTube and creating a YouTube channel is that you get to share some of your expertise, some of your knowledge, some of the information and things that you want to share, and sometimes cut through some of the BS with some of the things. And that's what this channel is about. So there's going to be a lot of changes that are going to be coming here in the future, and adding just much more meaningful content to how and what we do at Terra Firma as an asset coach and tax strategist. Really taking what we do as an organization and clients that become members and go through our ecosystem of tax planning and asset planning and asset coach and tax strategist. And so I'm going to actually start going through our process here on this channel to guide you and direct you, just give this information to you to show you how, as an asset coach, what steps do we take? Why do we take it? What's so important? What's the driving factor? What's the outcome? What's the benefit? What's the results for you? And at the end of the day, it's not designed for you to go, oh my goodness, I want to go hire Bob and his team. That may be the case, but really it's here's information. This is information that I've learned over the last 20 years. I didn't create this information. I read hundreds, if not thousands of books. I went to countless seminars. I've done continuing education credits for the various licenses I hold, and just information and knowledge that I've gathered from constantly being a business owner, just like you, trying to strive. What do I need to do, or what can I do? More importantly, what can I do to create the results that I want and I desire? Okay. And so that's what we're all about here on this channel as an asset coach and tax strategist. So the changes that are going to occur is giving you more meaningful, in-depth conversation and information. Yeah, these articles are awesome. This is great to kind of go through and read through between the lines, and we'll be able to do that in conjunction with the content that we're going to provide to you as an asset coach and tax strategist. And so we wanted to wait to get to our 100-member level to start actually diving deep into providing this type of content. Really, it's just to see if what my voice projects is being accepted and received by others. Okay. And so, and at the end of the day, 100 subscribers, awesome. Do all 100 of you watch every week when we drop an episode every Thursday? No, of course not. I see the views. In fact, in some episodes we have, 3, 4, 500 viewers more than what we have as subscribers. That's the whole point of content. If I'm not providing enough content to where I do get a viewer, but they don't want to hear or see future, then that's fine. That's what the whole point of this avenue of training and education is all about, and content is all about. But I just want to make it more meaningful, as this is my reward to you guys, is just wanting to be more meaningful, give more content, provide and give you more free information that gives me the avenue to go through an article and say why I believe we need to read between these lines and what my opinion is. Again, my opinion. Okay. But as we start going through asset coach and tax strategist content and what we do, it's really not any longer going to be my opinion. It's going to be how the rules are designed to play this game called life, especially from a financial perspective, in tax perspective. It's all intertwined. Even though the industries are separated, it's all intertwined. So anyways, so that's my gift to you guys. I'm excited. It's really a gift to me as well, because I love and thrive on this content. I've created tons of courses, the Tax Return Academy, the Farming Assets course. I have my Economic Termites book, my Farming Assets book. I have another podcast with my partner Joe, and we have one of our coaches on there, Aaron, called Wealth Mavericks. And so there's just a ton of content that we're pouring out into to you. And so anyways, well, this is going to be an article that is really recent, and this is just going to be a teaser. This is an example of what we're talking about in understanding how the rules are played, and what to be prepared for and understand. So let me share my screen here. Boom. Okay. So this is Yahoo Finance. This just came out. When was this? This is by the AP, Associated Press. It was posted on Yahoo Finance. And let's see, this was the 17th. So yesterday, it was updated yesterday. And it's a quick read, but here it is. The IRS wants to end another tax loophole for the wealthy and raise 50 million in the process. Now, let me define this word loophole. This word loophole is what the general public, or really media, uses to drive your interest. This is clickbait. Using this terminology, tax loophole, is clickbait. It's designed for you to go, ooh, what is there? That's clickbait. But the reality is that there aren't tax loopholes. There's the tax code. Now, just like in any game, any sport, anything we do as a hobby or what in our profession, there are certain rules and guidelines that we do, that we strategize and play to, and actually utilize these rules to enhance the outcome. So these loopholes are where really smart people have enhanced the rules that are already there. They're not doing anything illegal. If they were, they wouldn't be trying to audit them. They would be throwing these people in jail right away, right? They'd be arresting them. No, that's not the case. The case is the Congress passes law. The IRS, the Treasury Department, is in charge of interpreting that law from a tax perspective, and is in charge of collecting taxes based on what Congress's law has passed. Okay, so that's why a lot of times there's a law that passed and it has a certain aspect to the tax code. It takes a while for that to be implemented into our tax system, because some of the things the IRS has got to interpret. What the heck do we do here? What are these lawmakers thinking? Which is law and regulations, which is why it's the fourth termite in my book, but the most dangerous termite. It's the queen termite. It's the one that can change the rules on a dime, hence this article, that affects what you're able to do. Now, they're going to raise $50 billion, and it's on the wealthy. And the reason why it's on the wealthy is not because the wealthy are trying to lie, cheat, and deceive. Now, that's a general comment. There are, like always in everything, bad actors. Okay. But not every single person that uses this rule is a bad actor. Now, there's certain things that you need to understand as we go through this process of what this means. So let's go through this article. It's a quick read. They say it's a 2-minute read. So maybe it is, maybe it isn't, but let's kind of go through and see what they're talking about really quickly. Okay. So the IRS plans to end a major tax loophole for wealthy taxpayers that could raise more than $50 billion over the next decade. Now, notice when anytime you see an article like this, anytime you see an article like this, they talk about how much they could raise over what? A decade. Every single time. Not this year. They're not raising 50 billion this year. It's going to be over the next decade. Why? Because it just takes time. That's what I just was talking about. The Congress passes law, the IRS, the Treasury Department has to figure out how to interpret it and actually implement it. Now, when they go and audit these wealthy taxpayers, notice they're still taxpayers, okay? Wealthy taxpayers, meaning they're wealthy people paying taxes, okay? They're not saying wealthy non-taxpayers, okay? What they're trying to say is that these wealthy taxpayers, we want them to pay more tax, and the way we're going to do that is we're going to change the rules, okay? Now, again, don't get me wrong. There are bad actors. But if they were bad actors and they're going after the bad actors, it wouldn't be a fundraise, a tax increase of revenue over 10 years. It'd be, we're going to do this. We're taking these, we're serving them papers, we're taking them to tax court, we're clearing the dockets, we're taking them to tax court. No, that's not how it works. This runs really slowly. How slowly? A decade. What's $50 billion going to be worth based on inflation in 10 years? 40 billion, right? So anyways, let's move on. The proposed rule and guidance announced Monday includes plans to essentially stop partnership basis shifting. Okay, I'm going to explain what this is in a minute. A process by which a business or person can move assets among a series of related parties to avoid paying taxes. Okay, now, so here's where the bad acting and the good acting lies. Notice it says a business or a person, okay, a partnership is a business entity. Okay, it is a business entity. It is a tax structure entity. So when you start a partnership, you have to have two or more. So it creates a partnership. Can't have a partnership with one. Now you can have a business entity with two people or more and not be a partnership, and that's a corporation. Okay, but a partnership is two or more. Okay, and the percentage of partnership depends on the agreement of the two or more. So if these two people go into business and they say, hey, let's split everything down the line 50-50, then each partner owns 50% of that partnership. And at that entity, a separate business entity that has financial statements and whatever product or service they're providing to the economy generates revenue. That revenue has expenses to run that partnership. You subtract those expenses from the revenue. Duh. This isn't rocket science. This is elementary math, right? So you subtract your expenses from your revenue, and that equates profit. That profit passes through to each partner based on their partnership percentage, which in this case is 50-50. So that half of the profit goes to one partner, the other half of the partner profit goes to the other partner. Those partners, it's called a K1. Those partners now take that profit and they put it on their 1040 personal tax return and pay taxes on that. Okay. Now, so it's not a person moves assets. It's a person within a business, but you can have businesses that are partners. So that's why they're saying a business or a person, because you can have businesses. So let's take the same two partners. Okay. And let's say instead of doing them as individuals in a partnership, they both have a corporation. Okay. So ABC Corporation and XYZ Corporation own 50-50 of this partnership. Okay. So that's where the business part of this goes into play. Partnership still works the same way, whether it's a person or a business. Okay. It's a pass-through entity. Okay. Now, what they're saying is that they're moving assets. What are assets? Cash, property, could be real estate, could be businesses, anything. An asset is anything, based on Robert Kiyosaki, anything that creates income, something that's designed to appreciate and grow. Okay. Now, if you have something that appreciates and grow, it doesn't create taxable income until that appreciation of that property gets sold, and then it creates income. Okay. So the only thing that is taxed is the income from these assets, not the asset itself, unless they're shifting the asset to a separate partnership or something else to sell it and not have paid taxes. Okay. So now here's the thing. Basis shifting. What they're talking about in basis, this is cost basis. What that means is that your principal, your contribution, your investment, the value of what you're putting into it. Okay. So what they're doing is that your basis, after a period of time, if you shift it, you're actually allowed in a business entity to lose. So not profit, but lose on your K1, have a negative K1. All right. And this negative K1 actually gets to be offsetting all your rest of your income up to your basis. So for example, let's put numbers into this. I put in $100,000. That's my basis. That's my contribution. Or my partnership grew enough revenue, created enough profit for the 100,000. That's cost basis. Okay. So it could be your contribution, or it could be the profit left over to be added to basis. Okay. That's your contribution. Okay. So principal. Now, if you lose, let's say 100,000, you got a negative K1 over a year or multiple years, and now your basis is 0 from a tax perspective. Okay. So any other loss that you receive, actually, the way the IRS works is that you receive negative K1 beyond your basis. It's considered distribution or capital gains from that entity. So you pay your capital gains tax of 15 or 20%, depending on your tax bracket. Okay. So what happens here is that we get to our negative 100,000, we hit our basis, our negative K1, we hit our basis. And then what happens is, what they're saying is that people are moving these assets to another partnership. What's that do? That creates the value of that asset, whatever the value is. So let's say that 100,000 actually grew to 200,000 in the period of time. So it's like real estate. Let's say real estate, it appreciated 100%. So now it's at 200,000. They took negative K1s to their basis. And what they do is they just shift that property to another partnership. What's that now? It's a 200,000 basis in that new partnership. That's what they're talking about here. Now, in real estate, you could sell that asset and do something called a 1031 exchange. 1031 is the tax code, to where you can say, I'm taking my asset, my profit, my taxable gains, and I'm shifting principal and profit into another property. And that's a way to shift basis legally, but you sold the asset. You took an action of selling the asset and then buying another asset, and you can buy that other asset in another partnership if you wanted to. Doesn't matter. It could stay in this partnership or another partnership. Does not matter. Okay. So, but what's happening is that businesses or persons, what they're doing is they're taking losses on their partnership, getting that negative K1 to basis, and then shifting those assets to another partnership. That's what they're saying. Now, again, so far, the rules have said you can do that. So what they're doing is, it's like in football. Okay. You have a really good offense. Let's say a quarterback. So let's say like Patrick Mahomes, for example. Okay. Great quarterback, comes into the league. The league has defensive coordinators have seen quarterbacks like this, but he's at a different level. So what do the defensive coordinators have to do? They have to change their game plan. Right? They got to bring on better people, better defenders. They got to shift and create new defenses, okay, to be able to defend this particular quarterback. You may be able to slow him down, but not stop him. Okay. But then what happens if the defense coordinators do a good job of that? Then the offensive coordinator has to do the same. That's what's happening here, right? The game was designed. Now you have offensive strategies, and now the defense, the IRS, is saying, hey, time out, time out. We're changing our game plan to defend you better. Okay. Now, I don't think this is a bad thing. Why? Why is this important? Because you're supposed to be in business to have a purpose of business. Okay. So in running a business, setting up an entity, your main purpose is to make money. Now, that doesn't always happen, but your desire is to offer a product or a service to generate revenue. It doesn't say generate profit, but generate revenue. You're in business and purposeful in business. You can show that you're in business. You've hired a couple of employees, taxpayers, and you're running a business. Now, Amazon, public company for 20 plus years, as a public company, showed no profit. In fact, showed losses on an annual basis for 20 straight years, give or take. Why? Because they are taking profit, reinvesting that profit back into the business, setting up other business, but they are in business to make money. They were in business to set a business. They started other businesses. They invested in these businesses. Some of them failed. The government knows that. They're not saying you can't lose money. They're saying you need to be in business as a purpose to make money. This is not. What they're saying here is this partnership basis shifting. There are some bad actors that are doing this without the motivation and the focus of being in business at the purpose of making and building a business. They're just moving assets, shifting assets to not pay taxes. I agree that you should not be doing that. That is necessarily, it's like in football, that may be something like where you're recording the other team's offense and what their play calling is, right? In baseball, recording the pitch calls, right? Or whatever the case may be. There are certain things in the rules you can record and video a game, but you can't record and video specific aspects of it to take that and basically cheat. Okay, so you're still recording, you're still following the rules, you're still able to set up partnerships and shift businesses and stuff. But if your sole purpose is to tax shelter, these tax shelters allow wealthy taxpayers to avoid paying what they owe. They don't owe crap unless they're cheating and they're bad actors. And here, I'd have to say, okay, I'm in agreement. There's no reason to be a bad actor. But if you are doing this unknowingly, in the sense that you're trying to generate more revenue, you're trying to build a business, and your purpose is to be in business, and you have proof and evidence of that, then you're not a bad actor. You're not doing this just to evade taxes. You're doing this to build a business. And by building a business, you end up hiring employees, taxpayers, which is the revenue generated by the government, because they grade everything on their budget based on payroll taxes, payroll, income taxes, not profit of businesses. Okay. So due to previous years of underfunding, so it talks back about the IRS, blah, blah, blah. The IRS says filings of large pass-through businesses used for the type of tax avoidance and increased 70%. Okay. And their audit rates fell. Well, their audit rates fell because the businesses increased. Right? So it's basically statistics. It's going to happen if your number increases and you're auditing 1,000 businesses, and all of a sudden there are more businesses that are added to it, and you're only auditing 1,000. Well, of course your percentage is going to drop. This is why I'm not a big fan of percentages, because the core numbers affect the percentage. Okay, but it's okay. That there's a 160 billion gap between the top 1% earners. Well, that's okay. That's okay. This 160 billion gap between the top, how many people do they employ if they're business owners? What actually tax amount do they pay? They may not be paying 24% tax rate or 18% effective rate like most taxpayers, taxpayers. That's because they're a business owner. They're employing hundreds of taxpayers. So this is where I call BS. Okay. Stop trying to say the top 1% earners don't pay taxes. They do. Not the same percentages, but they do pay taxes, whether it's through building a business, growing a business, and hiring more employees, or through their own taxation. Okay. The difference, though, is wealthy use multiple types of assets. And within real estate, you have the ability, based on tax law, to actually invest in real estate, have a good tax benefit. Same thing with a business. If I go start a business, there's a cost associated with that. So if I have a profitable business and I take the profit and I start another business to help grow the overall business profile of both businesses, which is what Amazon's done, which is what all businesses do. And that is the right aspect of this. But they're talking about large pass-through businesses, and what they're really focusing on is IRS plans to raise, let's see here, what's guidance, continue story, 250 million. So, okay, so the IRS plans to raise audit rates on companies with assets over 215 million. That's a lot. So they're not going after the small business owner. It also plans to increase audit rates by tenfold on large, complex partnerships with assets over 10 million. What's a complex partnership? I don't know what that means. Okay. And they are using that vague, large, complex partnerships to basically give them the ability to define what that means, right? They don't specifically say other than over 10 million assets. Okay. So this is what they're focusing on. Okay. So do I think this is right? Well, yeah. Monday's announcement is part of the IRS's going effort into zero in on high wealthy tax cheats who manipulate the tax code or don't pay the taxes at all. Again, don't pay taxes at all is not the bad thing. The bad thing is they're cheating or manipulating the tax code to purposely not pay taxes, in the sense that they're setting things up to not grow and build a business, right? There's a distinction, and you may consider it a fine line distinction, but the reality is that is the distinction. Okay. So I just want to make that clear, because I've had a couple people come out to say, oh, Bob, you guys talk about, doing entity, setting up entities to income shifting. No. We're not shifting income. What we're doing is we're setting up entities to create income. You have money in this business. You have profit in this business. Let's use this to start another business to create more revenue, which creates what? More income taxes, potentially hires more employees. Okay. That's what we're talking about, is the generate wealth is that you have to shift income. You have to into entities. You have to. But if your motivation is not to make money and grow a business, but your motivation is to not pay taxes, then yeah, there's a point in time where the IRS is going to say, time out. Enough is enough. And here we are with this, and they highlighted it, 250 million or more, or large complex partnerships of 10 million in assets or more. Okay, assets, not revenue, not profit, assets. Okay, so there you are. That's it. Thanks so much for subscribing, and cannot wait for us to start pouring more content into you as an asset coach and tax strategist, and just fired up. So thank you so much for your subscribership. If you have not subscribed yet, subscribe. There is so much more to come. We drop every Thursday. So if you're not subscribing, you don't know when we're going to drop. You're not going to remember. If you're busy like me and everybody else, you're not going to remember. You're not going to put a little calendar alarm to say, oh, let me go search Asset Coach and Tax Strategist YouTube channel because they're dropping on Thursday. Forget all that. Just hit the subscribe button, and then we'll be notifying you. YouTube does that for you. They're your alarm system. And then when we drop on Thursday, you will get notified, and then you can join the exciting information and content that we're going to be providing. And there's so much. Let me just tell you, over 300 videos in my courses. So you can imagine how much amazing content we're going to be dropping for free, just giving it to you. Okay, because we want you to understand what's out there. I'm going to take my 20+ years of experience of learning about the finance world, taxes, assets, and just going to pour it into you, and see what you can do with it. Thanks so much for subscribing. God bless you. Bye-bye.